The average American household working with a financial advisor pays somewhere between $2,000 and $10,000 every single year for that relationship. Many middle-class families sit across from their advisor every year, nod at the charts, sign the paperwork, and walk out of the office feeling like everything is fine. Hidden banking fees and layered costs quietly drain investment accounts year after year, without most people ever realizing it. Clients are often shown polished retirement presentations without fully understanding the long-term consequences of the products being recommended. But here is what nobody tells you. There is a version of that meeting where your advisor walks you through 11 things that would fundamentally change how you manage your money. Two retirees can end up with completely different futures depending on the hidden costs and strategies inside their financial plans. Many investment contracts contain hidden fee layers buried deep inside the paperwork. Some financial products are designed to generate larger profits for the industry than for the client. Wealthier clients often receive access to completely different financial strategies and planning opportunities. The financial services industry is built on a set of structural incentives that make silence more profitable than full transparency. Until you understand those incentives, you are not getting the full picture, no matter how many years you have been a client. Most investors never receive the full picture they deserve unless they start asking the right questions. So today we are having the meeting your advisor never scheduled. These are 11 things financial advisors will never tell you for free, and by the time we are done, you will understand your money at a level most people never reach. This is not an attack on financial advisors. Most of them are not bad people. This is an education in incentives, understanding what your advisor is being rewarded for. The moment you understand what your advisor is being rewarded for, you will understand why certain conversations never happen in that office. You will understand why certain products keep appearing in your portfolio. You will understand why the advice that would benefit you most is often the advice that costs them the most to give. The financial advice industry in the United States manages over $100 trillion in assets. That number is so large it becomes meaningless. What is not meaningless is where the profit in that industry comes from. It comes from you. And knowing exactly how that profit flows changes everything. Let's get into it. This is the one that stops people cold when they first hear it. Most financial advisors are not legally required to put your interests first. There are two legal standards that govern financial advisors in the United States: the fiduciary standard and the suitability standard. A fiduciary is legally required to act in your best interest at all times, even if it pays them less. A fiduciary must recommend what is best for you, even if that option earns them less compensation. An advisor operating under suitability only has to recommend products that are suitable for your situation, not necessarily the best option available. A significant portion of financial advisors in the United States operate under the suitability standard, not the fiduciary standard. They can legally recommend a mutual fund with a 1.2% expense ratio when a nearly identical fund exists with a 0.03% expense ratio, as long as the more expensive one is considered suitable. The expense ratio difference between two nearly identical funds can cost you tens of thousands of dollars over time. The first question you should ask any financial advisor before signing anything is this: are you a fiduciary? And get the answer in writing. Ask for a signed fiduciary pledge before any paperwork is signed. Once you understand the difference between fiduciary and suitability standards, you will review your financial paperwork very differently. A well-informed client does not just accept verbal assurances, they demand written documentation of their advisor's legal obligations. Most people think they know what they pay their financial advisor. They see the advisory fee and assume that is the whole story. Inside your portfolio, every fund you hold has its own expense ratio, and those costs compound silently against your returns every year. Ask your advisor for a full fee disclosure, and you may discover far more layers than you expected. Annual advisory fees can quietly increase over time, while your retirement account grows or shrinks in the background. The difference between a 1% fee portfolio and a 2.5% fee portfolio can exceed $400,000 in lost growth over 20 years. Research has estimated that the total cost of a typical advised portfolio can run between 2% and 3% annually, quietly leaking from your retirement account. On a $500,000 portfolio, that is $10,000 to $15,000 per year, leaving your account in fees. Compounded over 20 years, the difference between a 1% fee portfolio and a 2.5% fee portfolio can exceed $400,000 in lost growth. Ask your advisor for a full fee disclosure, not just their advisory fee, but every expense ratio in every fund you hold. Ask them to show you every expense ratio and explain what each one is paying for. Many retirement portfolio dashboards show a visible advisory fee while hiding the real total cost buried in the fine print below. Know every line of cost inside your investment portfolio, every expense ratio, every trading cost, every 12b1 fee. Many financial advisors receive compensation that goes beyond the fee you pay them directly. Mutual fund companies and insurance providers frequently pay advisors through commissions and revenue sharing when clients are placed into their products. This creates a situation where advisors may have a financial incentive to recommend certain products, regardless of whether they are the most advantageous option for you. Compensation arrangements labeled commissions, revenue sharing, and incentives are legal, but rarely disclosed in a way that makes the conflict obvious. You deserve to know exactly how your advisor is being compensated before you agree to anything. The answer is often buried in the fine print. A commission-based annuity can generate extraordinary advisor compensation, and that compensation comes embedded in the cost structure of the product you just bought. A commission-based annuity can pay an advisor between 4% and 8% of the premium up front. On a $200,000 annuity, that is up to $16,000 in a single transaction. That compensation does not come from thin air. It comes embedded in the cost structure of the product you just bought. The brochure may look straightforward, but the compensation structure built into an annuity can be far more complex than what is visible on the surface. This does not mean every commission-based advisor is acting improperly, but it does mean you deserve full transparency. You deserve to know exactly how your advisor is being compensated before you agree to any financial product. In many compensation models, every dollar paid to the advisor visibly comes out of the client's investment account, whether or not the client realizes it. The wealthiest investors understand something most middle-class investors do not. The after-tax return is what matters most. The return on your investment is not what matters most. What matters is the after-tax return, what actually arrives in your account after the government takes its share. Most financial advisors spend the majority of their time talking about performance and almost none of it talking about tax implications. Asset location. Which investments you hold in which type of account can have a dramatic effect on your long-term wealth. Holding high-growth assets in a Roth IRA allows them to compound and be withdrawn completely tax-free. High-growth stocks inside a Roth IRA compound tax-free year after year, one of the most powerful long-term wealth tools available. Holding bonds or dividend-producing assets in a tax-deferred account means you are not paying taxes on that income annually. Asset location is about strategically organizing which assets go in which accounts to minimize your overall tax burden. Tax loss harvesting allows investors to turn losing positions into tax savings, a strategy rarely discussed in standard advisor meetings. These are not advanced strategies, they are fundamentals, but they require your advisor to coordinate across your entire financial picture, and many do not. If your advisor has never mentioned Roth conversions or charitable giving in the context of your specific tax situation, that is a conversation worth initiating. Tax-efficient retirement planning involves Social Security documents, Roth conversion schedules, and charitable giving strategies working together. Understanding the tax map across all of your retirement accounts is one of the most valuable things a financial advisor can help you build. Too often, the tax strategy conversation never happens, and the opportunity silently disappears year after year. If your advisor has never discussed your specific tax situation in depth, that conversation is overdue, and you should be the one to initiate it. Over any given 15-year period, roughly 85% to 92% of actively managed mutual funds underperform their benchmark index. No matter how hard fund managers try to outperform the market, the data consistently shows that simple, low-cost index investing wins over time. That data comes from the S&P Dow Jones SPIVA report, which has tracked consistent fund underperformance for over 2 decades. 85% to 92% fail to beat the benchmark, and yet a significant portion of advised portfolios sit in actively managed funds that charge higher fees precisely because of the promise of superior returns. A simple portfolio of low-cost index funds with expense ratios below 0.1% outperforms the majority of actively managed alternatives over time, net of fees. The difference between a low-cost index portfolio and a cluttered high-fee actively managed portfolio is dramatic when measured over decades. Your advisor may not tell you this freely because low-cost index funds generate significantly less revenue for the advisory ecosystem than actively managed products do. Advisors may subtly steer clients toward expensive managed products because those products generate more revenue, not because they deliver better results. Investors who discover that a simple 3-fund index portfolio quietly outperformed complex actively managed strategies are rarely surprised once they understand the math. The case for low-cost index investing is not complicated. The evidence has been clear for decades. Life insurance is a legitimate and important financial tool for many people. But before we continue, this one deserves careful attention. Life insurance is also one of the highest commission products in the financial services industry, with compensation structures that create powerful incentives. Whole life, universal life, and variable life policies can generate commissions of 50% to 100% of the first year's premium for the advisor who sells them. That is an extraordinary incentive, commissions of 50% to 100% of the first year's premium. For most working adults with dependents, a straightforward term life insurance policy provides the death benefit coverage their family actually needs at a fraction of the cost. For most families, term life insurance provides full protection at substantially lower cost than permanent life insurance alternatives. The premium difference between a whole life policy and an equivalent term policy can be several $100s per month. Invested consistently over 30 years, that premium difference compounds into a number that most whole life cash value projections cannot match. When you compare whole life cash value projections against long-term index fund investing with the premium savings, the results are striking. If you are not a high net worth individual with a specific estate planning need, a permanent life insurance recommendation deserves a second look. If your advisor has recommended a permanent life insurance product, it is worth getting a second opinion from a fee-only fiduciary who earns no commission on what they recommend. Commission-free advice on insurance recommendations is one of the most valuable things a fee-only fiduciary can provide. The average American couple will receive somewhere between $500,000 and $1.5 million in Social Security benefits over the course of their retirement. That is one of the largest single assets in their entire financial picture, and most advisor meetings barely touch it. Most financial advisor meetings spend more time on investment allocation than on Social Security optimization, because Social Security planning generates no revenue for the advisor. There is no product to sell. There is no fee to charge. There is just strategy, and strategy without a product attached rarely gets prioritized. Social Security planning generates no commissions, which is exactly why it rarely gets the attention it deserves in a compensation-driven industry. The difference between claiming Social Security at 62 versus 70 can exceed $200,000 in lifetime benefits for a single individual. For a married couple using coordinated claiming strategies, the lifetime difference can exceed $400,000, especially when survivor benefits are factored in. Delaying Social Security benefits can dramatically increase your lifetime retirement income, and most people never receive a personalized analysis. Many advisors avoid detailed Social Security analysis because there is no product to sell at the end of the conversation. If your advisor has never walked you through a detailed Social Security claiming analysis specific to your situation, that conversation is overdue. A retirement planning office that takes Social Security seriously will have benefit projections, timeline charts, and lifetime income estimates as core planning tools. The difference between optimizing and ignoring your Social Security strategy can exceed $400,000 in lifetime retirement income. Most people have heard of the 4% rule, the idea that you can withdraw 4% of your portfolio annually and never run out of money. But your retirement number may be wrong. Your advisor may have used the 4% rule to calculate what you need to retire, while hidden market risks remain unaddressed behind the scenes. More recent research suggests that a 3.3% to 3.5% withdrawal rate may be more appropriate given current market valuations and longer life expectancies. Retirees today face inflation, healthcare costs, and lifespans that may extend 30 or 35 years, realities the original 4% rule was not designed to address. Your retirement number deserves a stress test that accounts for variable market returns, healthcare inflation, and a retirement that may last 30 or even 35 years. The difference between a 4% withdrawal rate and a 3.3% withdrawal rate on a $1 million portfolio is $7,000 per year in sustainable income. That gap has real implications for when you can retire and how much you need to save. A retirement roadmap that extends 35 years must account for healthcare expenses, inflation, and sequence of returns risk, not just portfolio size. If your advisor gave you a retirement number without walking you through those variables, you may be planning around a target that is too optimistic. A realistic retirement stress test includes inflation variables, healthcare cost projections, and multiple market scenarios, not just a single projected return. The difference between a retirement built on realistic conservative assumptions and one built on optimistic projections becomes painfully clear over time. The wealthiest clients get a different level of service. This is rarely acknowledged out loud, but it is universally understood inside the industry. Households with $2 million or more in assets receive proactive planning, quarterly calls, tax coordination, and access to alternative investment strategies. The average middle-class client waits in a standard lobby with a generic investment folder, while premium clients receive a completely different level of service. Advisors proactively call their largest clients, while smaller accounts sit quietly in the database, waiting for outreach that rarely comes. The revenue generated by a $2 million client justifies a level of service that a $200,000 client simply does not receive, and that gap is rarely disclosed. Financial advisory firms tier their clients by profitability, and the level of service you receive is directly tied to the revenue your account generates. The middle-class client at a critical wealth-building stage often needs the most sophisticated guidance and receives the least of it. Million-dollar clients receive tax coordination, estate planning, and alternative investment access that most middle-class clients never even know exists. If your household assets are below your advisor's threshold for premium service, you may not be getting the full attention your financial situation deserves. A fee-only financial planner who charges a flat or hourly rate has a direct incentive to give every client their full attention, regardless of portfolio size. Sometimes the most powerful financial move is recognizing that your investments are correctly positioned and leaving them alone. The financial services industry generates revenue from activity, trades, new products, rebalancing, creating a structural incentive to always be doing something. This creates a structural incentive for advisors to do something, even when doing nothing is the right call. Activity equals revenue. Research consistently shows that investor behavior, reacting to market volatility by moving money, is one of the largest destroyers of long-term returns. A great financial advisor will sometimes tell you to sit still, that the noise you are hearing is not a signal. The portfolio you have may be exactly right for where you are going, and the most powerful thing you can do right now is nothing. Dalbar's research has found for decades that the average investor earns significantly less than the market itself delivers, precisely because they do not stay put. Emotional investing decisions, chasing performance, moving money during downturns, quietly drain long-term portfolio growth in ways that compound over decades. The average investor consistently earns less than the market itself delivers, a gap driven almost entirely by behavioral mistakes, not market conditions. If your advisor only reaches out when there is something to buy or sell, that pattern is worth paying attention to. A quiet portfolio with no changes may actually be the correct strategy, and recognizing that is a form of financial sophistication. The most disciplined investors know how to sit calmly while chaotic financial news swirls around them without changing a thing. A good advisor will tell you directly, the market noise you are hearing is not a signal to act. Holding a long-term diversified portfolio through a market downturn without reacting is one of the most powerful things an investor can do. Here is the one that changes everything. You have more control than you have been led to believe. The financial services industry benefits structurally from the belief that managing your money is too complex to do without professional help. The foundation of personal wealth is not complicated, and once you understand it clearly, it stops feeling overwhelming. A household that understands the fundamentals of investing can build a wealth strategy that outperforms most professionally managed portfolios. A household that maximizes its 401k and Roth IRA contributions annually and invests in a simple index portfolio will outperform the majority of advised portfolios over time. A simple three-fund index portfolio with low costs and broad diversification is one of the most powerful long-term wealth tools available to any investor. The data is clear. Low-cost, diversified investing quietly outperforms complex, actively managed portfolios over 20 to 30 years, net of all costs. Staying consistently invested through volatility and ignoring financial media panic is one of the most important disciplines a long-term investor can develop. You need discipline, patience, and the willingness to ignore the noise. That is the foundation of long-term wealth. Your advisor brings genuine value when they help you navigate complexity you cannot navigate alone. Taxes, estate planning, coordinated retirement income. Financial education empowers you to walk into every advisor meeting as an informed partner rather than a passive passenger. Let me show you what the difference looks like in real numbers. Meet Daniel and Patricia. Same age, both 42, same household income, $140,000 a year. Both have $380,000 saved for retirement. Daniel's advisor has him in a portfolio of actively managed mutual funds, and the real cost of that arrangement has never been fully explained. Patricia asked her advisor the hard questions 5 years ago, and the answers changed everything about how she managed her financial future. Daniel's portfolio carries a blended expense ratio of 1.1% on top of a 1% advisory fee, a total cost most clients never fully calculate. His portfolio has averaged 6.8% annual returns before fees, but that gross figure hides how much is silently lost to costs every year. Daniel's advisor has never discussed Social Security strategy, tax location optimization, or whether his insurance products are appropriately structured. Daniel trusts the process, unaware that hidden financial leaks are quietly draining from his portfolio underneath the surface. Patricia found out she was paying 2.3% in total annual fees, a number her previous advisor had never clearly disclosed. Patricia moved to a fee-only fiduciary who approached financial planning with full transparency and a commitment to her best interest. She restructured her portfolio into low-cost index funds with a blended expense ratio of 0.08%, a dramatic reduction from where she started. She repositioned her high-growth holdings into her Roth IRA, locking in decades of tax-free compounding. Patricia ran a Social Security optimization analysis with her advisor last year, a conversation Daniel has never had. With identical contribution rates and identical gross market returns, Daniel's and Patricia's portfolio paths are now diverging dramatically. At 67, Patricia's portfolio is projected to be $340,000 larger than Daniel's, purely as a result of fee reduction and tax efficiency. That is not a market timing advantage. That is the compounding math of knowing what you are paying and what you are not being told. The compounding mathematics of fee reduction and tax efficiency over 25 years creates wealth differences that feel impossible until you run the numbers. Here is what to do this week. First, ask your advisor directly if they operate as a fiduciary at all times for all services they provide. Get the answer in writing. Ask for a signed fiduciary pledge before any paperwork is signed. Second, request a full fee disclosure, not just the advisory fee, but every expense ratio in every fund you hold. If they cannot or will not produce that document, that is information. Third, pull your last 3 years of investment statements and calculate your actual net return after all fees and taxes. Compare it to the S&P 500. Calculate your actual net return after all fees and taxes, and compare it to a simple index benchmark over the same period. Fourth, if you are within 15 years of retirement, schedule a Social Security optimization review with a fee-only planner. Fifth, visit napfa.org to search for a fee-only fiduciary in your area who charges by the hour or by the plan, not by commission. You do not have to fire your advisor, but you do have to be an educated client, and now you are. Picture two versions of yourself at 68 years old. The first version handed their financial life to someone they trusted and never asked the uncomfortable questions. That version arrived at retirement with a Social Security plan that failed to maximize lifetime income because no one ever ran the analysis. That version had a portfolio that looked good on paper until they calculated what it would have been with lower fees and better tax strategy. The second version asked the hard questions, not out of distrust, but out of self-respect, and built a retirement that looks exactly like what they planned. Asking hard financial questions comes from self-respect, not distrust. The most successful clients understand that distinction. The second version walked into every advisor meeting as a partner, not a passenger. That posture changes everything about the quality of advice received. At 68, that version enjoys a comfortable retirement with optimized Social Security income and investment balances that reflect decades of smart discipline. At 68, that version has $300,000 more in their account, a Social Security strategy that maximizes lifetime income, and a retirement built on informed decisions. No advisor, no matter how well-intentioned, will ever care about your money the way you do. That is not a criticism, it is simply the truth. Financial literacy is not optional. It is the foundation of every good financial decision you will ever make. The educated client walks into the advisor meeting carrying organized notes, fee reports, and specific questions, and that changes the entire dynamic. A well-informed client asking detailed questions about fees, fiduciary duty, and tax efficiency gets a fundamentally different level of engagement. The information has always been available. The hidden truths of the financial advisory industry are not secrets. They are simply things most people never think to ask about. The information was always available, and now you have it. The difference between financial confidence and financial confusion is not intelligence, it is education. When you finally see the fee drag calculated across decades, the numbers are almost impossible to ignore. Once you understand how the incentive structure works, calmly rejecting unnecessary expensive products becomes straightforward. Low fees, tax efficiency, and discipline, those three principles, applied consistently, build more wealth than any complex financial product ever will. A family that maximizes Roth IRA and 401k contributions every year, consistently, patiently, without interruption, is building serious long-term wealth. Ignoring sensational financial news and staying focused on long-term goals is not passive behavior. It is one of the most active choices an investor can make. The long-term gap between emotional short-term investing and disciplined long-term investing is not abstract. It is measurable, compounding, and permanent. The best advisor relationship is a collaborative one, where you bring knowledge to the table and your advisor brings expertise to meet it. A simple three-fund portfolio held patiently for decades will outperform the vast majority of complicated, expensive financial strategies. Understanding how the financial advisory industry truly works gives you a clarity that changes every future financial conversation you will ever have. Armed with knowledge about fiduciary standards, tax planning, and fee reduction, a middle-class couple can make decisions that change their entire retirement trajectory. Transparent fee disclosures, with every hidden charge clearly visible, are the foundation of an honest advisory relationship. Moving from expensive actively managed funds to simple low-cost index funds is one of the highest impact financial decisions most investors can make. Every year of fee reduction creates compounding benefits that grow larger and larger, building a wealth difference that becomes impossible to ignore by retirement. A sound retirement roadmap, built on optimized taxes, Social Security planning, and disciplined low-cost investing, extends smoothly into the future. Once you understand the full financial picture, reviewing retirement projections becomes an empowering experience rather than an anxious one. Two investors with identical incomes and identical market returns can arrive at retirement with dramatically different outcomes based entirely on the decisions in between. Take ownership of your financial future. The information is available. The math is clear. The only missing ingredient is the decision to act on it. Long-term compounding turns small annual fee reductions and disciplined savings into wealth differences that reshape retirement entirely. Request transparency. Request simplicity. Ask for the conversation your advisor never scheduled, and refuse to accept anything less. When you become an educated client, something changes on the other side of the table too. Advisors respond differently to clients who know what they are talking about, know what you are paying for. Every fee, every expense ratio, every compensation arrangement, that knowledge alone is worth thousands of dollars every year. The foundation of financial confidence is built on three things: financial literacy, tax strategy knowledge, and a clear retirement planning framework. The households that build quiet, consistent, lasting wealth are rarely the ones chasing the most exciting investments. They are the ones who stay the course. The goal of everything in this video is simple: a retirement where you have choices, stability, and the peace of mind that comes from planning correctly. Hidden fees disappearing from a portfolio, while long-term growth accelerates upward, is not just a visual metaphor. It is what happens when you take control. The hidden truths of the financial advisory industry have now been exposed, and what you do with that knowledge is entirely up to you. The conversation that needed to happen has now happened. You have the information. The next step belongs to you. The difference between a confused investor and a confident one is simply knowledge, and you now have it. Your money, your future. The information was always available. Now you know what to do with it.